Good morning, I'm Greg McKenna and welcome to Tuesday, the 1st of September's morning market wrap. Last night was a really interesting one if you're a stock trader, with the reverberations from Stanley Fischer's comments over the weekend, where he made this month's Fed meeting live. That saw stocks in Asia under pressure yesterday, stocks in Europe under pressure, the UK was out, remember, and then stocks in the US under pressure. That didn't stop energy markets rallying, and crude was up substantially again last night. It was up above $48 at one stage last night. That brought the rally to around $11 from last week's low, or 30%. That also took the market back into the old trend line that went back over a decade that we looked at some time back. So very interesting. The key to the move in crude was that OPEC made some noises, or the OPEC bulletin, I should say, made some noises that they were looking to talk to other producers about fairer prices. When Australia's iron ore producers did that, they got held down and told they weren't allowed to collude. But it seems in the energy markets it's okay. But it's always been thus, hasn't it? Very different story for Australian iron ore guys. Anyway, that's a political comment, not a trading comment, so I should be quiet. So that drove energy stocks up. It didn't help the energy market overall. And the DAX ended down 0.38%. And the negativity that we saw from Asia yesterday will look to permeate the market today, with the ASX futures down around 23 points overnight and looking to be under a little bit of pressure. That really brings the big question, I think, for markets at the moment, is to where exactly are we in this cycle? Henry Blodgett, Business Insider this morning, I think it's a lead on the site at the moment, he's written a really good story about, is this just the bounce you get? Talking about what John Hussman's had to say, we often get these 10% kind of bounces. Regular viewers know, and regular readers of my 20 seconds pieces at Business Insider or my Go Markets commentary know that I've been saying, this is, where the bounce was going to go. And we got within a few points of my expected bounce on the S&P 500 towards the end of last week. So I'm in the camp that thinks that the game has changed for stocks. I'm in the camp that says this is now a sell rallies. I'm in the camp that says that stock prices are going to be substantially lower on a 3 and 6 month time horizon. That obviously puts pressure on the ASX, but it's also putting some pressure on the Aussie dollar. And we saw that in Forex markets last night. Whilst the oil producers, the NOC and the CAD did really well, the Aussie was under pressure down here just above 71 cents. And the Kiwi got absolutely hammered last night. It's down at 63.60 this morning and looking incredibly weak. But if we have a look at the Aussie dollar, and I'll share a chart with you here, the Aussie dollar is testing a trend line that goes back to the lows in September 2001. And what we see here in this chart, this is the chart I used both in my Go Markets report and my 20 seconds report at Business Insider. So, we've had, that's not exactly a touch. I'm not counting the April 2001 low as the touch. I'm starting from the September 11 low, because what the September 11 low did, or the post-September 11 low did, was it gave the bears a chance to sell Aussie and the bulls a chance to buy. So in that sense, that really was the bottom, and the buyers came back reasonably quickly after that. We've seen a few touches here in the post-GFC world, that 59.60, and that sense set up really where this chart is. So it's probably only had 3 or 4 real tests, and so you might say, well, is that a good example or not? That's a question, of course, for traders, and what they're going to be asking themselves is the Aussie slipping or holding? And the jury's probably a little bit out at the moment on that. My sense is that the Aussie will go and test somewhere in the 64, 66 cent range over the next sort of 6 to 9 months. So I guess in that sense, I'm a bear. If we think about, what's been driving that, Sam Rowe, one of my colleagues, one of the senior editors at Business Insider in the US, shared, saying the word shared is quite strange, isn't it? Anyway, he shared on Twitter a chart from Morgan Stanley, I believe, which I'll just bring up here, and we'll screenshot that, which shows, sorry, come on, there we go. Excuse me for the dead air time. Okay, so there we go. So what we've got here is this is the global growth cycle, developed markets and emerging markets, right? So notice that the Aussie is here stuck with the emerging markets. China's not at bottom yet. Australia's not at bottom yet. But growth is bottoming. Maybe that's a good thing. Maybe it means the RBA is live today. Maybe it just means that the Aussie dollar is under continued pressure. I think it's the latter, that the Aussie dollar remains under pressure at the moment. And I think that is something that the Reserve Bank is not going to fight, because what's clear is that the fall in the Aussie dollar is helping out the economy. Now, if we switch back overseas for a moment, the price action last night in US bonds was interesting. Westpac's Wellington-based strategist Imre Speiser highlighted this morning that Fed fund futures are now pricing only a 40% chance of a rate hike in September, only 60 cents in October, and 100% by March. So they're thinking December as the key, or the one after that. So I find 40% remarkable, given that the Fed has been telegraphing this for some time. And I spoke to the CIO of Colonial First State Global Asset Management Group, London-based Paul Griffiths for Business Insider, and he said that he thought that there'd been a degree of volatility factored into the Fed. Now, for some time, the Fed tightening has been the widely expected source of market volatility. The fact that it's come up in the lead-up is not really strange for those of us that have been trading for a long time. It won't be strange to people like Janet Yellen or Stanley Fischer either. And so Griffiths from Colonial First State's Global Asset Management team in London said that he thinks that they've backed themselves into a corner and they're going to go in. So, we'll know in a couple of weeks, but that just tells us there's going to be a lots of volatility. Now, on the data front today, we've got the AIG Performance Manufacturing Index, which is out at 9:30 today in Australia. China releases the official PMI at 11 a.m. and then we get building permits and Q2 current account for Australia at 11:30. 5 minutes later, we get the Japan version of the market earnings and market PMI 10 minutes after that. So it's going to be a big day. And then, of course, we've got China market open, we've got RMB fix, we've got the RBA at 2:30. So it's going to be a pretty big day. And if we have a look at the setup from around the grounds, the Dow was down 0.69, NASDAQ was off 1%, S&P down 85 basis points at 0.85%. London was closed. Tokyo was down yesterday. Shanghai was down yesterday, even with that late rally. ASX futures are pointing down 23 points, and the Aussie is holding just above 71 cents. So it's a bit of a fractured day, very tense day for traders in Asia, and it's going to be a very interesting next 24 hours, particularly if you're in Australia, because these partials will lead into the GDP number tomorrow, and there's a real chance that GDP in Australia is going to be negative after yesterday's company profits and inventories. So good luck out there, traders. I'm Greg McKenna. I'll leave it there with you. Stay safe, good trading, and bye for now. I'll see you at 9 a.m. or at Business Insider. All the best. Bye for now.